Right now, there are two types of people who use credit cards. The first type is getting paid, literally. Free flights, hotel upgrades, 5% cash back on groceries. They're using a piece of plastic to build wealth, and their bank is basically funding their lifestyle. The second type, they're paying for that first person's rewards. They're stuck in a cycle of minimum payments, watching their balance barely move, paying sometimes 25 to 30% interest on money they already spent. Here's the wild part, they both have the same card. So the real question isn't, should I get a credit card? The question is, which person are you going to be? By the end of this video, you'll know exactly how to be the first one. But I'm also going to show you the specific traps that turn people into the second one, because the line between the two is thinner than most people think. And there's one thing about credit cards that almost nobody talks about. It's not the rewards. It's not the interest rate. It's something that happens quietly in the background, whether you're paying attention or not, and it shapes your financial life for years. We'll get to that. Let's get into it. Credit cards are one of those things that personal finance people either love or completely warn you away from. Dave Ramsey says, cut them up. Travel hackers say they're the greatest financial tool ever invented. They're both kind of right. The honest answer is that a credit card is a tool. And like any tool, what matters is whether you actually know how to use it or whether you're just winging it and hoping for the best. Most people in their early 20s get their first credit card for one of three reasons. They needed it for emergencies, someone told them they should build credit, or they got approved at a table outside a football game for a free t-shirt. None of those are bad reasons, by the way. But if you started using it without actually understanding what you were holding, that's where things can quietly go sideways. So we're going to break this down properly. The real pros, the real cons. No fluff. And by the end, you'll have a clear picture of whether a credit card or a specific type of credit card actually makes sense for where you are right now. Pro number one, you build credit history, and that matters more than people realize. This is the thing I teased earlier, your credit history. And most people think credit scores only matter when you're buying a house someday. So they don't pay attention to it in their 20s. That's a mistake. Your credit score affects your ability to rent an apartment, get a car loan, sometimes even get certain jobs. A solid credit score can save you literally tens of thousands of dollars over your lifetime in lower interest rates. And here's the thing. The length of your credit history is one of the biggest factors in your score. That means the earlier you start building it responsibly, the better your score looks in 5, 10, 15 years. Using a credit card and paying it off every month is one of the simplest and most effective ways to build a strong credit history. You're essentially getting paid to do something you were already going to do, buy stuff you needed. Pro number two, rewards, cash back, and points. This is the fun one. Some credit cards will give you 1 to 5% back on every single purchase you make. Groceries, gas, subscriptions, restaurants, it all adds up. Let's do quick math. If you spend $2,000 a month on a card with 2% cash back, that's $40 back per month, $480 a year for doing literally nothing differently than you already were. And that's just cash back cards. Travel rewards cards take it further. Some people use sign-up bonuses, which can be worth hundreds of dollars in travel, to fly to places they never could have afforded otherwise. Done right, this is a legitimate strategy that financially savvy people use all the time. The key phrase there is done right. We'll come back to that. Pro number three, purchase protection and fraud coverage. This one is underrated and almost nobody talks about it. When you pay with a debit card and someone steals your money, that money is gone from your bank account while you wait for a dispute to resolve, sometimes for weeks. When you pay with a credit card and someone steals your info, it's the bank's money on the line, not yours. You're not paying it while the dispute is investigated. Most major credit cards have zero liability fraud protection, which means if someone runs up charges on your car that you didn't make, you're not responsible for them. Beyond fraud, many credit cards also come with purchase protection that covers items if they're damaged or stolen within a window of time after purchase. Some come with extended warranties on electronics automatically. These are real benefits that most people don't even know they have. Pro number 4, a safety net for actual emergencies. Look, the goal is to have a solid emergency fund in a savings account, but life moves fast, especially when you're younger and not everyone has 3 to 6 months of expenses saved yet. A credit card can be a short-term bridge in a genuine emergency. Unexpected car repair, a medical bill, a flight home for a family situation. Used that way, with a plan to pay it off quickly, it serves a legitimate purpose. The danger is when emergency starts meaning, I really wanted that thing. That's the slippery slope. But for actual emergencies, it's a useful backstop while you're building your savings. Pro number 5, convenience and security for everyday spending. This one's simple. Credit cards are accepted almost everywhere. They're easier to use online. They don't expose your bank account directly. And if you're traveling, especially internationally, a credit card with no foreign transaction fees is significantly cheaper and safer than using a debit card abroad. Some cards also offer travel insurance, rental car insurance, and trip delay protection automatically when you book travel through them. You might be carrying coverage you didn't even know about. All right, here's where we keep it honest. Con number 1, interest rates are brutal, and they're not hiding it. The average credit card APR right now is somewhere between 20 and 27%. Some store credit cards go even higher. If you carry a balance, meaning you don't pay the full amount off every month, you are being charged that interest on whatever you still owe. Let's make that real. You put a $1,000 purchase on a credit card with 24% APR. You pay the minimum each month. Depending on the minimum, it could take you 3 to 4 years to pay that off. And you'd end up paying somewhere around $400 to $500 in interest on top of the original $1,000. You paid $1,500 for a $1,000 thing. And the rewards you earned? Probably $20. This is where most people get hurt. They think of the credit limit as their money. It's not. It's borrowed money. And when borrowed money is expensive, it works against you very fast. Con number 2, the psychological spending effect is real. Studies have shown, and honestly, you don't even need a study. Just pay attention to yourself, that people spend more money when they're paying with a card than when they're paying with cash. The pain of paying is literally reduced when you swipe. You're not handing over physical bills. It's an abstraction, a tap, a click, and that slight detachment from the transaction makes it easier to not feel the weight of what you're spending. If you're someone who already struggles with impulse spending, a credit card with a $5,000 limit can make that a lot worse. Fast. The reward points don't mean anything if you're spending $300 more a month than you would have without the card. Con number 3, fees that quietly eat into your rewards. Annual fees, foreign transaction fees, late payment fees, balance transfer fees, cash advance fees. Some of these you know about going in, others you don't notice until you're checking your statement wondering why your balance went up. High-end travel cards sometimes have annual fees of $95, $250, even $550 per year. Now, for some people, the rewards completely justify that, but only if you're actually using the benefits. If you're paying $250 a year for a premium travel card and you fly twice a year for weekend trips, you're probably not coming out ahead. Always do the math on your actual spending habits, not the ideal version of yourself you imagine when you're signing up. Con number 4, a hard hit to your credit score when you apply. Here's something that catches people off guard. Every time you apply for a new credit card, the bank does what's called a hard inquiry, on your credit report. That can temporarily drop your credit score by a few points, usually 5 to 10. That's not a huge deal in isolation. But if you apply for multiple cars in a short window, those inquiries stack up and your score takes a more noticeable hit. And ironically, applying for cars to build credit can briefly hurt your credit score. Something to be aware of. Con number 5. The debt spiral is a real thing, and it starts quietly. This is the big one, and it doesn't happen all at once. It usually looks like this. You carry a balance 1 month because money was tight. No big deal. Next month, you pay the minimum because there's another expense. The balance stays about the same. You buy something on the car because you told yourself you'd pay it off, but then you didn't. And now, a year later, you're carrying $3,000 on a card you never intended to have a balance on. That's not a worst case scenario. That's a very average American story. Credit card debt in this country is measured in trillions of dollars. And the people holding most of it didn't plan to be there. They just didn't have a plan, period. The trap isn't a single bad decision. It's the accumulation of small, easy decisions that don't feel like decisions at the time. So here's where we land. Credit cards are not good or bad. They're a leverage tool. And leverage amplifies whatever you're already doing. If you're disciplined with your budget, pay the full balance every month and choose the right card for your actual spending habits, you come out ahead. You're building credit, earning rewards, and getting protections that your debit card doesn't offer. If you're carrying a balance, making minimum payments, or using your credit limit as a psychological extension of your income, the bank is winning, not you. The one rule that separates the two groups is almost embarrassingly simple. Only spend on your credit card what you already have in your bank account. Treat it like a debit card that also earns rewards and builds credit. That's it. That's the whole strategy. Because the rewards are only actually rewards if you're not paying more in interest than you're earning in points. The math is not subtle. And the credit building only helps you if you're building good credit, not a history of late payments and high utilization. So before you get a credit card or before you get another one, ask yourself honestly, do I have a spending plan right now? Do I know what I spend on food, on entertainment, on subscriptions? If yes, a credit card might genuinely work in your favor. If not, start there first. Because a credit card doesn't change your financial habits, it just amplifies them. If this was useful to you, there's probably someone you know who just got their first credit card or is thinking about getting one, who would actually benefit from watching this. Send it to them. That's worth more than a like, honestly. Until next time, spend with intention. Thank you for watching.